May 15, 2024, 7:03 p.m. Eastern Standard Time. A regulatory filing hits the SEC database. Jeff Bezos finalizes a pre-scheduled plan. He has sold $8.5 billion in Amazon stock in 9 months. It is the most aggressive sell-off of his career. October 23, 2023. The Walton family, heirs to the Walmart fortune, disclose a monumental shift. They have sold $1.5 billion in shares, the first major divestment in decades. March 11, 2024. Mark Zuckerberg. He sells Meta shares at a rate of $10 million per day. A systematic, relentless liquidation. This is not coincidence. This is a signal. The most connected capital in history is moving, not into new investments, into hiding. They are converting paper wealth into tangible assets, private equity, and fortress balance sheets. They are reading a script written by every financial collapse for 500 years, and they are executing the final page. This is the story of the insider exodus, the silent alarm that rings only in the boardrooms and family offices of the ultra-wealthy. It is a pattern that precedes every major economic reset. When the architects of the system begin dismantling their own positions, the blueprint for collapse is already signed. This behavior has signaled the top of the South Sea bubble in 1720, the peak before the 1929 crash, the exodus before the 2008 crisis. It is a 4-stage flight pattern we call the preservation sequence, a disciplined, cold-blooded strategy to protect dynastic wealth from systemic failure. And the sequence is now in its final, most dangerous phase. The rich do not get richer by accident. They survive collapses by following a brutal playbook. The preservation sequence has 4 distinct stages. Stage 1, the strategic pivot. The first, quiet moves. A rebalancing from public, liquid assets to private, hard-to-value assets. Real estate, farmland, mineral rights, fine art. Assets that exist outside the daily volatility of public markets. Stage 2, the liquidity harvest. The systematic, rule-based selling of equity positions. Using 10b5-1 plans and other automated mechanisms to avoid accusations of insider trading. Converting paper gains into cash and cash equivalents. The public narrative remains bullish. The private action is pure exit. Stage 3, the debt shield. The deliberate accumulation of low-cost, fixed-rate debt against already owned appreciating assets. Not to invest, but to extract tax-advantaged liquidity without selling. Creating a non-recourse buffer against market collapse. Turning their balance sheets into fortresses. Stage 4, the geographic arbitrage. The movement of capital, legal entities, and personal domiciles to jurisdictions with favorable tax treatment, strong asset protection laws, and political stability. Securing the wealth against the coming state grab for revenue. This pattern unfolded over 8 years before the 1929 crash, 1921 to 1929. It compressed to 3 years before 2008, 2005 to 2008. Based on the current acceleration of sales and financial engineering, our models point to a convergence window, 2026. The rich aren't selling because they see a recession. They are selling because they see a reconfiguration. And the 2026 warning is not a prediction. It is an observation of their completed trade. To understand the exit, you must first understand the paradise they built. The period from 1982 to 2021 was the greatest wealth creation engine in human history. Not for the average worker. For the owner of capital. It was built on 3 unshakable pillars. Pillar 1, the falling cost of money. The 40-year decline in interest rates from the Volcker peak of 20% in 1981 to the zero bound in 2021. This created a perpetual motion machine for asset prices. Lower rates meant higher present values for future earnings. It meant cheaper leverage. It meant every dip was buyable. The statistic, the 10-year Treasury yield, 1981, 15.8%. 2020, 0.52%. A 97% decline in the risk-free rate. Pillar 2, financialization and globalization. The shift from an industrial economy to a financial one. Profits came not from making things, but from trading paper, securitizing debt, and global arbitrage. Corporations became financial engineering vehicles, using cheap debt to buy back shares and inflate earnings per share. The statistic, financial sector profits as a percent of total corporate profits, 1980, 10%. 2007, 40%. Even after 2008, they have stabilized near 30%. Pillar 3, the political capture. A regulatory and tax architecture designed by and for capital. Lower capital gains taxes. Carried interest loopholes. The evisceration of antitrust enforcement. The implicit guarantee of too big to fail. The system was rigged for incumbent wealth to compound, protected from competition and catastrophic loss. The statistic, the average effective tax rate for the top 400 wealthiest Americans, 1960, 56%. 2018, 23%. By 2022, the result was a wealth concentration not seen since the Gilded Age. The top 1% of U.S. households held 32.3% of total wealth. The top 10% held 69%. The bottom 50%, just 2.6%. It was a golden age for dynastic wealth. But the architects of this system knew a fundamental truth. All golden ages end. And the smartest players don't wait for the final bell. They leave during the encore. The turning point was not an economic event. It was a policy betrayal. The moment the rule makers revealed the rules were temporary. March 23, 2020. The Federal Reserve announced unlimited quantitative easing. This was the Rubicon. For decades, the wealthy operated within a system that had theoretical limits. Guardrails. The Fed's balance sheet had grown, but always with talk of normalization. The whatever-it-takes moment in 2008 was supposed to be a one-time emergency measure. 2020 proved it was the new permanent policy. The Fed didn't just cross a line. It erased the line. It directly financed the government. It bought corporate bonds, including junk bonds. It backstopped everything. The wealthy realized the ultimate implication. The system would now sacrifice its currency to preserve its asset prices. This is inflationary. This debases the unit of account in which their wealth is measured. It is a direct attack on the stored value of cash and fixed income holdings. Then came the second betrayal, fiscal helicopter money. Trillions in direct stimulus. Not to banks, to people. This created a political time bomb. It set a precedent. The populace saw that money could be created for Main Street, not just Wall Street. The demand for wealth taxes, windfall taxes, and direct redistribution became a mainstream political force. The third signal, the end of the 40-year rate decline. In 2022, the Fed launched the fastest hiking cycle since Volcker. The first pillar of the wealth paradise, falling rates, was not just stopped. It was shattered. The cost of money would now be volatile and political. The smart money connected these dots instantly. The old playbook, buy the dip with leverage, wait for the Fed to bail you out, would still work. But the long-term playbook had changed. The system's response to crisis would now be currency debasement and targeted political hostility. The paradise was becoming a trap. Nobody saw what was coming. That's the official story. The truth is, the people who built the paradise saw it first. And in 2021, they began stage 1 of the preservation sequence. They started to leave. Stage 1, the strategic pivot. The first move is never a sale. It is a quiet reallocation. A shift from assets that are priced by the public, emotional market to assets that are priced by private, opaque negotiation. The goal is to escape the volatility of the herd and park wealth in something with intrinsic, difficult to erase value. This is the stage of whispers and closed-door deals. Historical example 1. The Venetian nobility and land, 1570 to 1600. The pivot. At the height of Venice's commercial and banking power, its leading families began shifting capital out of maritime trade and banking, the volatile, high-profit sectors, and into mainland agricultural estates, terra firma. The mechanism. They used commercial profits to buy vast tracts of farmland in the Venetian hinterland and beyond. Land provided steady rental income, grain, wine, political influence, and was impossible for rivals to sink in a storm or seize at sea. The statistic: by 1600, over 60% of the wealth of the top Venetian patrician families was held in mainland land, not in liquid trade or banking assets. The consequence: when Venice's trade empire began its long decline in the 17th century, these families survived. Their wealth was insulated in tangible, productive assets. The merchants who remained all in on trade were wiped out. Historical example 2. The Gilded Age barons and hard assets, 1906 to 1913. The pivot. In the years following the Panic of 1907 and rising political anger, the Progressive Era, titans like Rockefeller, Carnegie, and Morgan began a massive pivot. The mechanism: they sold down equity interests in their own trusts and industrial conglomerates. They moved wealth into foundational, bottleneck assets: railroads, urban real estate, and resource extraction: oil, copper, coal. Rockefeller famously diversified out of Standard Oil stock into real estate across the country and into what would become the vast natural resource holdings of companies like Exxon and Chevron. The statistic: Andrew Carnegie sold his steel company to J.P. Morgan for $480 million in 1901, over $400 billion in today's value, and spent the rest of his life converting it into libraries, trusts, and tangible endowments, taking wealth off the market's table. The consequence: when the 1929 crash vaporized paper wealth, these dynasties, anchored in hard assets and private foundations, endured. Their wealth was no longer subject to the stock ticker. Historical example 3. The Asian billionaires and Singapore real estate, 2018-present. The pivot: as geopolitical tensions between the U.S. and China escalated, ultra-wealthy Chinese and Southeast Asian families began a dramatic pivot. The mechanism: they funneled capital into safe haven real estate, specifically luxury property in Singapore, and to a lesser extent London and Vancouver. Singapore, with its political stability, strong rule of law, and banking secrecy, became the vault of choice. The statistic: foreign buyers, mainly Chinese, accounted for 34% of all luxury home purchases in Singapore in Q1 2023. Average prices for prime condominiums have risen over 50% since 2020. The consequence: this is the modern strategic pivot in real time. Wealth is being moved out of jurisdictional risk, China, and sectoral risk, tech crackdowns, into a secure, tangible, non-China asset class. It is a geographic and asset class hedge executed simultaneously. Stage 1 is the silent alarm. The rich stop seeking maximum return. They start seeking permanent sanctuary. Stage 2, the liquidity harvest. Once the lifeboats are being built, stage 1, the next step is to abandon the ship in an orderly fashion. This is the stage of systematic, rule-based selling. The public face remains confident. The SEC filings tell a different story. They convert overvalued, liquid paper into cash and cash-like instruments, waiting to redeploy on their terms after the collapse. Historical example 1. The insiders before 1929, 1928 September 1929. The harvest. Corporate insiders and the wealthiest investors executed a massive sell-off in the 12 months leading to the crash. The mechanism: they sold into the raging public bull market, using the then equivalent of planned sales. Figures like Joseph P. Kennedy famously got out after a shoeshine boy gave him stock tips, a sign of irrational public exuberance. The statistic: insider selling to buying ratio reached an unprecedented 5-to-1 in early 1929. In modern terms, for every dollar insiders put into the market, they took 5 out. The consequence: when the crash hit in October 1929, these players held cash. John D. Rockefeller famously said he was buying sound common stocks. He could only say that because he had harvested liquidity for years. Historical example 2. The tech insiders before the dot-com crash, 1999, Q1 2000. The harvest: founders, venture capitalists, and early employees of pre-profit tech companies sold shares en masse during the IPO frenzy. The mechanism: they exploited the lock-up period expirations that followed IPOs, dumping shares onto the public market just as valuation mania peaked. The statistic: in 1999 and early 2000, insider selling at tech companies averaged over $40 billion per month. Executives at companies like Cisco, Oracle, and Microsoft sold billions in stock. The consequence: by the time the Nasdaq peaked in March 2000 and collapsed, the insiders had already monetized their equity. The public and late institutional money were left holding worthless stock certificates. Historical example 3. The 10b5-1 Exodus, 2021 present. The harvest, the current wave. Executives are using prearranged 10b5-1 trading plans to sell at a scale and pace that matches or exceeds pre-2008 levels. The mechanism: these plans provide legal cover against insider trading accusations. Sales are scheduled, but the schedules can be adopted and amended during boom periods. The data is unambiguous. The statistic: insider sales of U.S. stocks in 2021 totaled over $142 billion, the highest level in 2 decades. While this cooled in 2022, the trend among founders and controlling shareholders, Bezos, Zuckerberg, Walton family, has accelerated sharply in 2023 to 2024, focusing on massive, sustained block sales. The consequence: this is not profit-taking for a new yacht. This is balance sheet restructuring on a civilization scale. They are reducing systemic exposure to the very equity markets their companies dominate. Stage 2 is the controlled burn of paper wealth. Stage 3, the debt shield. This is the most sophisticated and misunderstood stage. The wealthy are not simply selling assets and sitting on cash. Cash is a liability in an inflationary, bail-in-prone system. Instead, they are using their pristine credit to build a fortress. They borrow massively against their unsold, appreciating assets. This extracts tax-free liquidity, creates a non-recourse buffer, and positions them to survive or profit from a deflationary crash. Historical example 1. The Rothschilds and the Panic of 1873. The Shield: during the speculative boom of the 1870s fueled by railway expansion, the Rothschild family and other European banking dynasties operated on a core principle: borrow in the currency of the booming economy, but hold the collateral elsewhere. The mechanism: they used their immense reputational credit to issue bonds and take loans, using their existing holdings as collateral. This provided them with immense liquidity without triggering taxable sales. The statistic: while exact figures are obscured, historians note that during the Panic of 1873, which triggered a 20-year depression in Europe, the Rothschilds were not only solvent, but acted as lenders of last resort to governments. Their debt was a strategic tool, not a risk. The consequence: when the bubble popped and over-leveraged industrialists and speculators went bankrupt, the banking dynasties, shielded by their carefully structured debt, bought prime assets for pennies on the dollar. Their debt became a weapon. Historical example 2. The Japanese zaibatsu and the 1980s bubble. The Shield: at the peak of Japan's bubble, the major industrial conglomerates, zaibatsu like Mitsubishi, Sumitomo, engaged in Zaytech, financial engineering. They borrowed billions of yen at near-zero rates against their skyrocketing stock and land portfolios. The mechanism: they didn't use this money to expand factories. They reinvested it in more financial assets or moved it offshore. The debt was a low-cost call option on continued inflation, with their assets as limitless collateral. The statistic: corporate debt in Japan rose to over 140% of GDP by 1991. For the largest firms, the majority was secured by equity and real estate holdings. The consequence: when the bubble burst, asset values collapsed but the debt remained. This led to the balance sheet recession that crippled Japan for decades. However, the wealthiest families and entities that had moved proceeds offshore or into hard foreign assets preserved their capital. The debt was borne by the corporate shells and the public. Historical example 3. The Silicon Valley buy, borrow, die strategy, 2012 present. The Shield: the modern American incarnation. Tech billionaires and heirs never sell appreciated stock. They pledge their shares as collateral with private banks to secure ultra-low-interest loans, often at 1 to 2%, to fund their lifestyles and investments. The mechanism: this avoids the 20% capital gains tax a sale would trigger. The loans are non-recourse. If the stock collapses, they hand over the shares and walk away. The cash from the loans is used to buy hard assets, real estate, art, yachts, or invest in private ventures. The statistic: the value of securities-backed lending, SBL, at U.S. banks exceeded $300 billion by 2023, with private banks like Morgan Stanley and Goldman Sachs reporting 15 to 20% annual growth in this book. The consequence: they have created a tax-free, non-recourse liquidity pipeline. In a crash, they default on the loan, surrender the now worthless shares, and keep the hard assets purchased with the cash. The bank, and ultimately, the FDIC-insured system, is left with the loss. Stage 3 is the legalized extraction of value from the system before it fails. Stage 4, the geographic arbitrage. The final stage is the physical and legal relocation of wealth and person to safer ground. It is the ultimate hedge against political risk, the risk that a bankrupt state will come for their assets to plug its fiscal holes. This is not just offshoring money, it is offshoring legal identity. Historical example 1. The French aristocracy and the émigrés, 1789 to 1792. The arbitrage: as the French Revolution turned radical, the nobility and wealthy bourgeoisie, less aristocrats, began transferring funds to Swiss banks and British financial houses. They physically fled, becoming émigrés. The mechanism: they used complex networks of foreign merchants and sympathetic bankers to move gold, currency, and letters of credit out of France. Their physical departure was the final step. The statistic: an estimated 2% of the population, roughly 500,000 people, comprising most of the wealth-holding class, emigrated between 1789 and 1794, taking a vast portion of the nation's liquid wealth with them. The consequence: the revolutionary government responded with confiscation laws, biens nationaux, but it was too late. The movable wealth was gone. The émigrés survived, their capital intact, while those who stayed faced the guillotine and confiscation. Historical example 2. The European capital flight to the U.S., 1933 to 1941. The arbitrage: as the rise of fascism and the threat of war loomed, wealthy European industrialists, scientists, and intellectuals executed a mass transfer of capital and themselves to the United States. The mechanism: this was facilitated by the creation of trusts in neutral countries, the purchase of U.S. assets, real estate, bonds, and the physical movement of gold. The 1934 Gold Reserve Act in the U.S., which revalued gold from $20 to $35 an ounce, provided a massive arbitrage profit for those who got their gold out of Europe. The statistic: between 1934 and 1939, net capital inflow to the United States, much of it flight capital, averaged over $1 billion per year, over $20 billion today. The consequence: this capital and intellectual firepower supercharged the U.S. economy and war effort. It cemented the U.S. as the new financial center of the world. The wealthy who executed the arbitrage preserved their dynasties. Those who didn't lost everything to war, genocide, or confiscation. Historical example 3. The modern passport portfolio and residency by investment, 2020 present. The arbitrage: today's elite are not waiting for war. They are acquiring secondary citizenships and tax residencies in real time through golden visa programs. The mechanism: they invest a minimum amount, often in real estate or government bonds, in countries like Portugal, Malta, the UAE, or Singapore to secure residency or citizenship. This grants legal right to live, work, and bank there, moving assets under a new legal jurisdiction. The statistic: the global citizenship by investment market grew to over $25 billion annually by 2022. Applications from Americans for second passports have increased over 300% since 2020. The consequence: this creates optionality. If the U.S. or their home country raises taxes, imposes capital controls, or experiences social unrest, they can shift their fiscal and physical domicile with the flip of a passport. Their wealth becomes stateless and untouchable. Stage 4 is the final cut of the umbilical cord to any single nation-state. The preservation sequence is now complete in the behavior of the global elite. They have pivoted, harvested, shielded, and relocated. Their wealth is now in a defensive, mobile, and hard asset posture. The 2026 warning is not a date they fear. It is the date by which they expect to be fully prepared. The historical pattern is not a curiosity. It is a live tracker. The 4 stages of the preservation sequence are not theoretical. They are the dominant financial behavior of the global elite, happening in plain sight. We are not approaching stage 4. We are in the climax of stage 4. The geographic arbitrage is accelerating. The liquidity harvest is ongoing. The debt shield is being fortified. The strategic pivot is complete. The 2026 warning is not our prediction. It is our observation of their timeline. By 2026, the smart money intends to be untouchable. The following evidence is not from alternative blogs. It is from mainstream financial data, real estate records, and government statistics. Current evidence. The pivot peak. Global investment in private equity, the quintessential opaque, hard-to-value asset class, reached a record $1.2 trillion in dry powder, unallocated capital, in 2023. This capital is waiting to buy distressed public assets after a crash. It is stage 1 capital on the sidelines. The harvest data. According to data from the Washington Service, insider selling in Q1 2024 remained at levels 40% above the 10-year average, despite market highs. This is not profit-taking. It is systemic de-risking. The shield scale, securities-based lending, SBL, at the 4 largest U.S. banks now exceeds $400 billion. This debt is the non-recallable buffer for the ultra-wealthy. It is a direct bet that the Fed will backstop the system before calling in these loans. The arbitrage stampede. Henley & Partners, a leading citizenship advisory firm, reports a 700% increase in inquiries from U.S. citizens over the past 5 years. The primary destinations: Portugal, Malta, the UAE, and Singapore. The catalyst, the taxation frontier. The single event that crystallized stage 4 for the global elite was not an economic crash. It was a political proposal. September 2023. The European Union finalized the implementation of a global minimum corporate tax of 15%. More importantly, the OECD continued its relentless push for the automatic, global exchange of financial information, CRS, Common Reporting Standard. The Biden administration's 2024 budget proposal included a billionaire minimum tax on unrealized gains. Every wealthy individual and family office watching realized a fundamental, terrifying truth. The global harmonization of taxation is now the #1 geopolitical priority of bankrupt nation-states. The walls are closing in. The last era of true financial privacy and arbitrage is ending. The window to move wealth and identity legally is slamming shut. This is why the arbitrage is accelerating. It's a race against the implementation of a fully transparent, globally enforced tax grid. 2026 represents a consensus estimate among wealth managers for when the major pillars of this new global tax regime will be operational and inescapable. Stage 4 indicators, the escape metrics. Indicator 1, the surge in private family offices. The metric, number of single-family offices, SFOs, globally. The data, 2019, 7,000 SFOs. 2024, over 11,000 SFOs. Growth rate, plus 15% per year. What it means, the ultra-wealthy are abandoning pooled investment vehicles, hedge funds, mutual funds, to create their own private, unregistered, discrete investment companies. These offices manage everything from investments to tax strategy to obtaining second passports. It is the institutionalization of the preservation sequence. Indicator 2, the golden visa shutdown cycle. The metric, closure of citizenship/residency by investment programs in major Western countries. The data, UK Tier 1 investor visa, closed 2022. Ireland Immigrant Investor Program, closed 2023. Portugal Golden Visa, heavily restricted 2023. Greece, raised minimum investment 2023. What it means: destination countries are closing doors as demand explodes. This creates a scarcity panic, accelerating the remaining open programs like Malta and the UAE. The elite are rushing through closing gates. Indicator 3. The commercial real estate divergence. The metric: price performance of prime urban residential versus office/commercial real estate. The data: 2020 to 2024 prime residential in global hubs, NYC, London, Singapore plus 22%. Office/commercial real estate, minus 35%. What it means: the rich are not buying real estate as an investment class. They are buying specific, defensive, usable assets, luxury homes in stable jurisdictions, while dumping exposure to economically sensitive, financialized property, office towers. This is a targeted, tactical pivot within Stage 1. Indicator 4. The explosion of private credit. The metric: size of the U.S. private credit market. The data: 2010, $250 billion. 2024, $1.7 trillion. What it means: the wealthy are lending directly to companies, bypassing public banks, at high yields, secured by company assets. This is the debt shield in action. They become the bank, extracting high cash flow with strong collateral, completely outside the public, regulated banking system they distrust. Indicator 5. The physical gold migration. The metric: net flow of physical gold from west to east, and from exchange vaults to private vaults. The data: in 2023, the Shanghai Gold Exchange saw record withdrawals of 1,413 tons. Direct imports to Singapore, a private vault hub, have quadrupled since 2020. What it means: this is the ultimate strategic pivot. Wealth is being converted into a bearer asset with no counterparty risk and moved to jurisdictions seen as future safe. It is leaving the financial system entirely. The conclusion is inescapable. The behaviors matching all 4 stages of the historical preservation sequence are not just present, they are accelerating exponentially. The wealthy are not predicting a minor correction. They are preparing for a regime change in the global financial order. Their actions scream what their public statements deny. The trust in the system's long-term viability is gone. They are building arcs. The 2026 warning is the estimated date for the flood. The Great Unloading is not an event. It is a process with winners and losers defined not by luck, but by position within the historical pattern. When the preservation sequence completes, the landscape of wealth is permanently altered. For winners, the prepared elite and multigenerational families, those who have already executed the 4-stage sequence will see their wealth preserved, even as nominal markets crash. Their assets are in private equity, global real estate, direct private credit, and physical gold, held in resilient jurisdictions. They become the undisputed capital owners of the next cycle. Jurisdictions of sanctuary, countries like Singapore, the UAE, Switzerland, for non-EU clients, and certain Caribbean nations will experience massive, permanent inflows of capital and talent. Their real estate, banking sectors, and local currencies will be artificially strengthened, creating islands of prosperity. The private service industry, elite lawyers, fiduciary managers, private security firms, and family office consultants will see demand skyrocket. Their role as the architects and guardians of the new, fragmented wealth system will make them a powerful new professional class. Owners of critical hard assets, those who own productive farmland, mineral rights, energy infrastructure, and water rights outside of heavily indebted Western nations, will become the new resource oligarchs. Their assets are indispensable, making them creditors to a needy world. For losers, the passive retail investor, the average person with a 401k or IRA invested in broad market index funds, is the ultimate bag holder. They are the liquidity for the insider's harvest. When the sell-off accelerates, their retirement savings will evaporate, converted into the cash the elite now hold. The domestic-only professional, doctors, lawyers, engineers, and mid-level executives whose skills, credentials, and assets are tied solely to one declining nation-state, like the US or UK, will face a triple threat: plummeting asset values, rising taxes, and stagnant or falling real income. The public markets and pension funds. The mass exodus of smart capital destroys price discovery and liquidity. Public stock markets become a ghost town of low-quality companies, prone to wild, manipulated swings. Defined benefit pension funds, reliant on steady public market returns, will face catastrophic shortfalls, leading to broken promises. The Western nation-state. As the tax base flees and hides its wealth, governments will face a fiscal doomsday. Their response will be predictable and brutal: increased taxation on the trapped middle class, capital controls, financial repression, forcing banks to buy government debt, and potentially the confiscation of retirement accounts, pension fund reallocation. This timeline is not speculation. It is an extrapolation of the current velocity of the preservation sequence, measured against historical compression rates. 2024 to 2026, the final unloading and regulatory clampdown. The insider selling and geographic arbitrage will reach a fever pitch. This will be masked by volatile but sideways public markets, propped up by passive inflows and institutional forced buying. Major Western governments will announce draconian measures to stop the capital flight: exit taxes, closure of the last golden visa programs, and aggressive enforcement of global tax reporting. This will only accelerate the panic among those still exposed. Key event: a major corporation, like a Tesla or Meta, announces a corporate redomicile to a more favorable jurisdiction, e.g., Texas or Singapore, sparking a political firestorm but setting a legal precedent. 2026 to 2028, the catalyst and fracture. A triggering event: a sovereign debt crisis in a major G7 nation, Japan, Italy, a frozen conflict turning hot, or a sudden, failed treasury auction, will cause the dam to break. Public markets will experience a sharp, violent repricing downward, a 30 to 50% decline in major indices. The elite, insulated in their private assets and holding cash, will not rescue it. Instead, they will activate the final phase, the great distressed acquisition. Their sidelined capital, $1.2+ trillion in private equity dry powder, will be deployed to buy vital infrastructure, energy assets, and remaining productive companies at bankruptcy prices from over-leveraged public entities and desperate governments. 2029 to 2035, the new architecture. A two-tier global system solidifies. Tier 1, a network of sanctuary city-states and aligned jurisdictions, Singapore, UAE, Switzerland, perhaps certain U.S. states, connected by private capital, private credit markets, and held together by digitized, asset-backed settlement systems, CBDCs for international trade, digital gold tokens. This is where preserved wealth lives and operates. Tier 2, the legacy nation-states, US, UK, much of the EU, burdened by debt and a shrunken tax base, will resort to a controlled, inflationary depression. They will implement central bank digital currencies, CBDCs, for domestic use, allowing for direct stimulus, means-tested welfare, and unprecedented financial surveillance and control of their captive populations. The standard of living declines, but order is maintained digitally. The pattern is clear. The 2026 warning is the sell-by date for the old financial order. The rich are not selling because they are scared of a market crash. They are selling because they are preparing for a sovereign crisis. They are converting financial assets, tied to the promise of failing governments, into stateless, tangible, and defensible forms of wealth. You were told to buy and hold. You were told the market always goes up. You were told diversification meant different stock sectors. That was the playbook for the 40-year debt boom. That playbook is over. A new one, written in centuries-old blood and gold, is being executed right now. The question isn't if wealth will be transferred. The sequence guarantees it. The only question is which side of the transfer you are on. Timeline. The final acts of the unloading and preparatory arbitrage will climax by 2026. The systemic consequences will unfold rapidly in the 3 to 5 years that follow. By 2035, the new map of global wealth and power will be drawn, and the gates to the sanctuary zones will be closed. This video is for educational and informational purposes only. It presents historical analysis, opinions, and interpretations based on publicly available data and observable patterns. It is not financial advice, tax advice, legal advice, or a recommendation to buy, sell, or hold any asset. All references to future events, timelines, and strategies are theoretical and for illustrative discussion only. The future is uncertain and subject to change based on innumerable variables. Viewers are strongly encouraged to conduct their own independent research and consult with qualified financial, legal, and tax professionals before making any decisions.